Welcome back to Rewind 2022. With the shockwaves of the COVID-19 pandemic fading or at least taking a backseat and the world's eagerness to a return to normalcy, the frantic dependence on healthcare has started to wane. Testing requirements fell, the large number of the population being protected through multiple inoculations, the frenetic rush to stock up on drugs also evaporated. Recovery levels rose, the world opened up, and all of this meant the diagnostic chains, healthcare centres, hospitals, drug makers and pharmacies saw their growth engines return back to normal. Back home, barring a few companies like Sun Pharma and Cipla, most pharma players have underperformed the frontline indices. Ekta Batra fills out an after-action report on the highs and lows for the Indian Medicare space in 2022.
2022 saw opportunities from COVID-19 dwindling. Case in points were the likes of Serum stopping manufacturing of its AstraZeneca vaccine, Zydus and Dr. Reddy's COVID-19 vaccine sales not really taking off, Wockhart's UK sales falling as supplies to the UK government dipped, and lastly, Divi's Lab seeing dwindling intermediate supply opportunities for Merck's COVID-19 drug Molnupiravir. For the US, an important development was a clutch of Indian companies such as Natco, Dr. Reddy's, Cipla launching the generic version of the blockbuster cancer drug Revlimid generic. Challenges included fierce price pressure in the US continuing with the likes of Lupin exiting certain drugs and Aurobindo delaying its injectable sales guidance of $650 to $700 million to FY25. It was also a patchy year for the US FDA inspections, with problems continuing for the likes of Sun's Halol facility, Cipla's Goa plant, Glenmark's Badi plant. Price pressure, delayed launches in the US, supply challenges along with inflation weighed on most companies' margins in FY23. Gland and Divi saw margins sharply fall in the first half. Aurobindo reported margins at a multi-quarter low of 13.7% in Q2, and while Lupin did see a recovery in margins in Q2, it disappointed with margins hitting lows of 7% at some point in the year. 2022 was also a year of acquisitions in India as companies scouted for growth. We saw companies either buying one or a portfolio of brands such as Dr. Reddy's and JB Chemicals, buying cardio drugs from Novartis, or Mankind scooping up Panacea's domestic brands. Not in the domestic market, but this year was also marked with the $3 billion buyout of global company Viatris's biosimilar business by Biocon. So what is the way forward in 2023? The ability to withstand price pressure in the US, which would be fueled by key drug launches in the US, such as Lupin's inhaler drug Spiriva generic, Cipla's cancer drug Abrixon generic, or Biocon's biosimilars insulin aspart and bevacizumab, and continued sales for Sun Pharma's specialty business. 2023 will also be marked by companies undertaking remediation to solve outstanding US FDA issues and taking steps to fuel growth in other markets such as India and even China. Let's leave you with valuations of the companies on an FY24 basis, what they started 2022 with and where they are ending the year.
Sonal Bhutra turns back the clock for a review of the real estate sector's year and explores possible risks that 2023 may throw up.
2022 was about a lot of things. An uptick in real estate cycle is definitely something worth highlighting. We are talking about a steep uptick in residential demand and sales. So let's look at some numbers now. Absorption in residential real estate is not 1, 2 or 3-year high, but at a decadal high. Absorption in residential real estate is basically the amount of space or units which are occupied within a market over a given period of time, typically 1 year. In calendar year 2022, so far, it is at 447 million square feet, which compares with 400 to 425 million square feet that we have seen in past couple of years. It even dipped to 281 in 2017 when the cycle was undergoing some decline. While absorption is increasing, inventories have been declining. Unsold inventory was a big pain point for developers as supply was exceeding demand. But now trends are seeing a reversal. Ready-to-move-in inventory is declining. From levels of 849 billion in 2019, it is now around 500 billion, and that is a big decline. That is for ready-to-move-in inventory, which was still more resilient than under construction. So if we look at the under construction segment, that has declined from calendar year 19 to calendar year 2022. Calendar year 2019, remember, saw a massive increase in inventories. So barring Hyderabad, in the top cities, there is a decline. 23% for Mumbai, 29% for Bengaluru, 14% for Chennai, 20% for Gurugram, 4% for Delhi, 34% for Pune. Only Hyderabad saw an increase of 145% in inventories. Decline in inventories was accompanied by increase in prices. We have been speaking to a whole host of developers, and they have been of the view that passing on price hikes in the last quarter was not very difficult. So price hikes in the September quarter in some geographies have been massive. 3 to 4% in Mumbai, 14% quarter-on-quarter for Delhi NCR, 30% YOY there. Hyderabad has seen a 10% price increase. Navi Mumbai at 14% YOY, up 8% sequentially, and Chennai has seen a decline sequentially, but an increase on a YOY basis. Bengaluru and Pune have also seen moderate price hikes. This is across the industry, including organized and unorganized players. But some experts are of the view that maybe it will not be easy to pass on price hikes now, considering the massive hike in interest rates as well as the inflation. If we look at how listed players have done, strong first half of FY23, more than 100% growth in some cases. Prestige, Macrotech, Mahindra Life Spaces saw more than 100% growth. We have Godrej Properties and DLF with more than 60% growth in bookings, Oberoi at 92%, the likes of Sobha, Kolte Patil, Brigade and Sunteck between 20 to 50%. So, what could the risk to this massive rally be? Definitely rising interest rates. RBI has hiked rates to 6.25% in last few policy meets. And we did ask some big real estate names, and DLF told us that demand for real estate sector was impacted when mortgage rates were at 9%, while Prestige Estates told us if mortgage rates cross 9%, it will impact real estate demand. So rate action from the RBI will be key to watch. Ending this data with some news we got some time back. This is related to commercial real estate, but only goes on to show the impact of rising rates. Blackstone and Starwood Funds Limited saw withdrawals from their real estate funds, and this was following surge of redemption requests. Big and small investors were queuing up to pull money out of real estate funds, which is a sign that yes, the surge in interest rates is threatening to impact at least the commercial property sector. These are two isolated cases, but whether it starts to have an impact on the entire sector, we'll wait and watch.
Over $100 billion worth of deals have been signed in the year. Even the startup space has seen a fair share of funding coming in, though the funding winter has put a chill into the proceedings. Nisha Poddar runs through the big M&A deals and trends of 2022.
The year 2022, as it comes to an end, has clocked in deals worth $118 billion so far, majority of which came in from the mergers and acquisition space, while private equity also participated with $33 billion. Now, in terms of the sector breakup, well, top 5 in M&A came in from first the banks and financial services topping the chart, followed by other sectors like manufacturing, IT, renewable energy, as well as logistics. Now, the private equity investments were highest in the e-commerce space in the year, followed by other sectors like media. We saw a lot of interest, infrastructure, energy, as well as the financial services. Let's also take you through the top 5 deals of the year. HDFC and HDFC Bank's mega merger clearly is the largest, boosting the overall deal value for the year. And the second one is Holcim Cement Assets, Ambuja, as well as ACC, and that was the most hotly contested battle amongst various conglomerates, won finally by the Adani Group. Now, Biocon's acquisition of Viatris's biosimilars business is also path-breaking in the context of an overseas acquisition done by an Indian company. Fourth on our list is the global steel giant ArcelorMittal's acquisition of SR Group's ports as well as power assets, critical to its steel assets, which, remember, marks the full and final completion of the SR Steel's buyout via the IBC process, which, remember, has been a very long-drawn deal. So that comes to an end now. And last is the Yes Bank equity deal by private equity firms Carlyle as well as Advent, which, remember, is an important milestone in Yes Bank's bailout plan. Now for the year ahead. Most deal makers are cautiously optimistic about the deal activity, and consolidation could be a big theme play out as economic pressures weigh on the weaker companies. Now the startup funding winter is already here and expected to intensify further. With the valuations volatile, well, deal closure could be a challenge, while private equity braces up for some value buying in the next year.
Well, the funding winter in the startup space may take a while to thaw out, but the bigger question is whether this chill will spread and result in more cases of frostbite. Answers to those questions as 2023 unwinds, but till those answers come in, here's wishing all of our viewers a very happy New Year.